The United States owes more money than any country in history, over $34 trillion, a number so large it barely feels real. Yet most people assume that this debt is owned by foreign countries, secret elites, or faceless global institutions pulling invisible strings behind the scenes. But what if the real owners are far closer to home, quietly shaping your future without you ever noticing? And what if understanding who owns this debt changes how you see taxes, inflation, retirement, and even your own savings? Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. To understand who really owns America's debt, we need to travel back to the very beginning, to a time when the United States was not a global superpower, but a fragile experiment struggling to survive, because the story of debt ownership is not just about money. It is about power, trust, and promises made across generations, and the roots of today's massive debt were planted more than 2 centuries ago. After the American Revolution, the newly formed U.S. government was deeply in debt, owing money to soldiers, foreign allies like France, and private lenders who financed the war. And instead of running from this debt, Alexander Hamilton made a bold and controversial move, arguing that the federal government should fully honor and consolidate all debts, creating trust in U.S. credit. A decision that shocked many at the time, but laid the foundation for America's ability to borrow ever larger sums. This early decision created a pattern that would repeat over and over again, because once investors believed the U.S. would always pay its debts, lending to the government became one of the safest investments in the world. And as America grew, fought wars, built infrastructure, and expanded social programs, borrowing became a convenient tool rather than an emergency measure. Fast forward to the 20th century, when two world wars, the Great Depression, and massive government programs permanently changed the scale of federal borrowing. And this is where the story takes an unexpected turn, because as the debt grew, so did the number of Americans who indirectly became lenders to their own government, often without realizing it. Here is where many people get it wrong, because when asked who owns U.S. debt, they immediately point to China or foreign governments, imagining that America is somehow owned by outsiders. But this belief only captures a small piece of the picture, and the reality is far more surprising and far more personal. The largest owner of U.S. debt is not a foreign country at all. It is Americans themselves, through institutions that quietly hold trillions of dollars in Treasury bonds, bills, and notes, including pension funds, retirement accounts, mutual funds, insurance companies, and even state and local governments. Think about your retirement for a moment. If you have a 401k, a pension, or a mutual fund, there is a very high chance that part of your money is invested in U.S. Treasuries. Because these securities are considered among the safest assets in the world, and fund managers use them to balance risk and ensure steady returns. This creates a strange but powerful relationship, because on one hand taxpayers are responsible for paying interest on the national debt, but on the other hand, many of those same taxpayers receive that interest indirectly through retirement accounts and investment funds, meaning the government is in many ways paying its own citizens. But this is only the beginning of the story, because one of the most important and misunderstood owners of U.S. debt is the Federal Reserve, America's central bank, and understanding its role requires slowing down and separating myths from reality. The Federal Reserve did not always hold massive amounts of government debt, but after the financial crisis of 2008 and again during the COVID-19 pandemic, it stepped in aggressively, buying trillions of dollars in treasuries to stabilize markets and keep interest rates low, a process known as quantitative easing. This move was designed to prevent economic collapse, but it also meant that a huge portion of U.S. debt ended up on the Fed's balance sheet, raising an uncomfortable question that many people avoid: what does it mean when the government effectively owes money to itself? The answer is complicated, because while the Federal Reserve is part of the government, it operates independently, and the interest it earns on treasuries is mostly returned to the U.S. Treasury after expenses, which means a portion of the debt interest flows back to the government, quietly reducing the net cost. This circular flow of money sounds reassuring, but it hides deeper risks, because the more the Fed intervenes, the more markets depend on it, and when the Fed eventually steps back, the consequences can ripple through interest rates, housing stocks, and the cost of living. Now let's address the part of the story that everyone talks about: foreign ownership. Because while it is not the largest share, it is still significant and politically sensitive, and this is where headlines often exaggerate fears. Foreign governments and investors own roughly a quarter of U.S. debt, with countries like Japan and China frequently mentioned. But here is the twist: these countries buy U.S. debt not to control America, but because they need a safe place to park massive amounts of money. For example, when China exports goods to the United States, it earns dollars, and instead of holding piles of cash, it invests those dollars in U.S. Treasuries, which are liquid, stable, and backed by the full faith and credit of the U.S. government. This creates a mutual dependence because while the U.S. relies on foreign buyers to help finance its debt, foreign countries rely on the stability of the U.S. financial system to protect their reserves, meaning sudden collapse or default would hurt everyone involved. But here comes a moment that often shocks people: foreign ownership of U.S. debt has actually been declining in recent years as a percentage of total debt, even as the overall amount has exploded, meaning America is increasingly borrowing from itself. This shift raises a critical question. If Americans own more of their own debt, does that make it safer or more dangerous? And the answer depends on how you think about inflation, taxes, and long-term economic growth. To understand this, imagine a family that borrows money from itself using different accounts. On paper, it still owes money, but the burden feels lighter because payments circulate within the household. Yet if income stops growing or expenses spiral out of control, the internal structure does not save them from consequences. This is exactly the dilemma facing the U.S., because while internal debt ownership reduces some risks, it does not eliminate the fundamental problem of spending more than the economy produces year after year. The breaking point in this story did not arrive with a single dramatic event, but rather with a slow accumulation of promises, including entitlement programs like Social Security and Medicare, which are not fully funded by current taxes and rely heavily on future borrowing. These programs were created with good intentions to protect the elderly and vulnerable, but as the population ages and fewer workers support more retirees, the pressure on government finances intensifies, quietly adding to the long-term debt burden. At the same time, political gridlock has made meaningful debt reform nearly impossible because cutting spending or raising taxes is unpopular, and borrowing has become the path of least resistance, especially when interest rates remain manageable. This is where the illusion of safety becomes dangerous, because low interest rates make debt feel cheap, encouraging even more borrowing, until a single shift in rates can dramatically increase the cost of servicing the debt. When interest rates rise, every new dollar of debt becomes more expensive, and even existing debt must be refinanced at higher rates over time, which means interest payments alone can crowd out spending on education, infrastructure, and public services. This leads us to the failed fixes, attempts to control the debt that sound responsible but often fall short, including debt ceilings, temporary spending freezes, and political standoffs that create uncertainty without addressing root causes. The debt ceiling, for example, does not limit spending that has already been approved. It simply restricts the government's ability to pay its bills, turning debt into a recurring crisis rather than a long-term planning issue. History shows us that countries rarely collapse because of debt overnight. Instead, they experience slow erosion through inflation, reduced growth, and declining trust, patterns that repeat across empires from ancient Rome to modern economies. Inflation, in particular, acts like a hidden tax, reducing the real value of debt, but also eroding purchasing power, meaning savers and wage earners quietly pay the price while debt holders may benefit. This creates a subtle redistribution of wealth, where those with assets that adjust to inflation can protect themselves, while those living paycheck to paycheck feel squeezed, even if they never hear the word debt in daily life. So who really owns America's $34 trillion debt? The answer is layered and uncomfortable. It is owned by Americans through retirement accounts and institutions, by the Federal Reserve through monetary policy, and by foreign investors seeking safety, all interconnected in a system that depends on trust. The first key takeaway is that U.S. debt is not a distant, abstract number. It is deeply tied to your savings, retirement, and future taxes, whether you realize it or not. The second takeaway is that debt is manageable only as long as economic growth outpaces borrowing, and once that balance shifts, tough choices become unavoidable. The third takeaway is that ignoring debt does not make it disappear. It simply transfers the cost forward, often to those least prepared to bear it. The warning embedded in this story is simple but powerful. The real risk is not who owns the debt today, but whether future generations will trust the system enough to keep it running. And the open-ended question we leave you with is this: if you are already a creditor to your own government, Do you have a say in how responsibly it borrows, or is that decision being made without you even noticing? Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.